When the economy is not growing so well, government will take actions through various policies, such as the fiscal policy, which is basically changing spending through tax and government spending. But what if spending was not increased by these means? Now central bank will take action. It has a secret weapon, quantitative easing, which pretty much means print more money and hope for the best. Normally, when the economy is weak, central banks lower interest rates. Lower interest rates encourage people to borrow, spend, and invest. But if interest rates are already at zero, and the economy is still not growing, quantitative easing comes in. Instead of lowering interest rates, the central bank prints money, not actually with printers, but digitally typing. Then uses these money to buy government bonds and other assets from banks. The idea is that banks now have more money to lend, businesses will borrow more, and the economy starts moving again. Sounds simple, but not entirely. It is the same concept with the trickle-down economy. Imagine you're at a giant water park. The central bank is turning on the quantitative easing water slide, hoping money will flow down to everyone in the economy. But sometimes, that water just fills the biggest pool, which is the banks, large corporations, and financial markets, while the small businesses and regular people will be only left with a few drops. Similarly, when the central bank buys bonds from banks, they hope those banks will lend more. But banks are not obligated to lend because they could just sit on the money or use it for things like stock buybacks. And this is where things get tricky. Quantitative easing can make stock markets skyrocket, making investors and wealthy asset holders richer. But for people working a normal job, they might not feel the boost at all. After knowing what quantitative easing is, let's talk about the real case that happened. After the financial crisis in 2008, the US Federal Reserve launched quantitative easing, buying trillions of dollars in bonds. Their goal was to lower long-term interest rates, make borrowing cheaper, and boost investments. Did it work? Kind of. The stock market recovered, businesses stabilized, and housing prices bounced back. But not everyone benefited equally. Since quantitative easing also makes assets more valuable, the wealthy, who own most of the assets, gain the most, while the wage growth for regular workers remains sluggish. Quantitative easing isn't a free lunch. It comes with risks. For one, if you print too much money, there will be inflation, and if you really overdo it, you get hyperinflation. When money loses value so fast, people need a wheelbarrow of cash just to buy groceries. Plus, quantitative easing makes it harder to stop future crises. If central banks keep printing money, what happens when the next recession hits? Is quantitative easing good or bad? Well, it depends. Think it as caffeine. It's only useful in moderation. Too much of it can leave the economy with a nasty crash in future time.